Yeah, so guys, maybe Wahid, you're the reason we started the space. Thanks for waking me up. Maybe give us a quick overview for anyone that just joined, and we have Gergevin on stage as well. So can someone give us an overview on what we've seen so far since the markets opened, relative to what you guys expected? You want to kick it off, Wahid?
Sure. So in terms of tools, everything we broke all of them last night. There hasn't been anything really incremental except for HSBC buying the UK arm of SVB Bank, and and the Bank of England and the UK Treasury saying they're going to do similar type of backstop, although we haven't seen exactly the details. But that's a very small, much smaller problem in the UK than obviously in the US. So that's the incremental policy tools. There hasn't really been anything policy substantial. What's happened is obviously the market's ripped, as we saw, and now, in European hours, the European banks started trading materially lower. And part of the reason why I think that is because when you mark to market balance sheets in Europe, having lived for more than a decade at negative rates, and suddenly you spike to 2.5%. Um, European sovereign bond yields, the actual duration mismatch in Europe is arguably worse. And so people are saying, okay, let's test the market. There's a wholesale lack of confidence in traditional banking, which we kind of knew was going to happen, right? Despite a huge amount of the policy tools that were implemented. And then the U.S. markets opened pre-hours, and First National Bank, there was talk about how beyond Signature Bank, the other banks are going to have a lot more support from the private sector. But what does that entail? People are immediately saying, okay, that's highly, highly, highly dilutive capital, right? So that's why the stocks are absolutely tanking, because there's zero appetite politically to make good on saving any equity shareholder, let alone bondholder, right? And when you have Biden saying he's going to punish the bad actors and blah blah blah, right? We're going to go back to this whole scapegoating, right? And
Yeah,
so,
to try
yeah,
to zoom in a little bit on what Amir is saying, just from a price action perspective, without me adding any opinion on the political attitude or environment. FRC opened down almost 70% in the pre-market hours. We have PACW, which is PacWest Bank Corp, down 40%. Credit Suisse, which there were some issues highlighted with Credit Suisse in the last few weeks and over the last few months as well, down 7.5%. Charles Schwab was down over 20% at one point, which is
Bought a
probably
ton
the
of
most
Charles
concerning
Schwab
of the
this
bunch.
morning, man. It was
Yeah,
up like eight
uh,
dollars a share from the
it was
lows.
down over 20% on the
It was
week last
insane.
week as well. But they
Yeah.
have they have a similar issue, or at least a perceived similar issue with their long duration treasury holdings. And some people believe that they have the same HTM problem if they're forced to liquidate those treasuries. Now, again, I haven't looked into the detailed nuance of that, and don't want to give you a conclusion on whether I think the risk there is the same. But the point is the market perceives it that way. That stock is the
yeah.
eighth largest bank in the United States, traded down 20% in a week for a bank of that size in general is a big move, but down over 20% in pre-market here. But now it's bounced, and it's bounced significantly, down only 5%.
Yep.
At KRE,
So
which is
so
the
I
So
I
the
think
thing with
ETF,
Schwab that people don't understand
opened.
is that
Yeah, Jay, let me just finish this. So the KRE, the regional banking ETF, which was actually green to open, um, as were some of the other big names. The potential beneficiaries of this: J.P. Morgan, Goldman Sachs, Bank of America, Wells Fargo. They were actually green to open the pre-market session. So you were seeing that dichotomy between the super banks and your big four and the regional banks, which continued to tank. And now there's not really much of a dichotomy at all. They're just all deep in the red. So yeah, that's just a price action update. But yeah,
yeah.
go for it.
Can I just
but
and I'll shut up.
there's
I
a huge
promise.
difference.
Yeah, if
I
I
mean, there's a huge difference. The large cap banks, JP Morgans, the B of A's, the Wells Fargos, continue to trade very strong. B of A, with the largest mortgage bond security exposure, is trading weaker than the very large names. The super regionals are strong. You look at State Street, you look at US Bank, you look at Bank of New York Mellon. The names that, I think the most interesting opportunity this morning was definitely Schwab with 173 billion of this HTM issue. If you were to market that they potentially would take a $30 billion hit to their tier one, but their tier one, is 4 times the size of their potential HTM losses. So the market could be overreacting to that. Whereas with SIVB, they had 15 billion of losses, which was more than their entire tier one capital. I mean, I've never seen banks trade like this since 2008.
Sure.
It's absolutely unbelievable, and there's so many different names to talk about. When you look at PacWest, I mean, PacWest has similar action to what we're seeing with FRC. FRC had tens of billions of outflows on Friday, and the issue, like Faith Tribe was mentioning earlier, is that you can't actually, all these firms will have to raise equity. The discount window is just a band-aid. You can only pledge securities to the discount window and raise capital to the extent that you have those securities available and at that LTV that you can raise that capital. If there are more deposits leaving your bank, then you have the ability to raise money at the discount window, by the way, which is terrible for your net interest margin. You can still go bankrupt even as a good firm, which is why, even though the management is smart and they have good customers, why the market is challenging FRC and it's down so much this morning.
So
Jay,
can I
just on
special
that.
situations? Let me just finish this and I'll shut up. I promise. So you hit the nail on the head. So thank you. I don't think the problem with the trading in the stocks has anything to do with securities held for sale. I don't think so. I think it's exactly what you said in your last point, which is there's zero political appetite. So they can access the window, they can access the bailout fund, they can do all that. But now they're going to be forced to issue equity at any price. And usually a board has a fiduciary duty to, what's the risk reward and what's best for shareholders and bondholders and everyone. No, none of that. They're going to get a call and they're going to say, you're going to fucking take this check from JP Morgan or B of A, etc. We don't care how much you get diluted. And that's what I think the price action is today.
Jay,
I
don't
think
you
they're
see this
also
as a bit of
realizing.
a self-fulfilling prophecy? So where the equity valuations are plummeting, right? So people are seeing that banks are effectively going towards zero, seeing this problem, starting to withdraw funds from those banks into tier ones. We'll see more of a bank run within those banks. Their stock prices continue to plummet, effectively making it impossible for them to raise money. And then the Fed needing to step into these regional and potentially some super regional banks.
Yes, it becomes a self-fulfilling prophecy. It was very similar back in 2008. The difference between now and 2008 is that I actually think that the systemic risk is a lot less than 2008, but information travels much faster than it did back then. I don't know if you guys remember when IndieBank went bankrupt in the summer of 2008. It took like 13 days. They were only bleeding out 100 million a day for them to lose even over $1 billion. And so they had time to figure out a plan on what to do with that bank. It was sold to One West. This was in Pasadena, California. But what people do, what the government might be lagging on is that the speed of their decision making is paramount, and the market is second guessing. The market is pushing for bailouts, and they're saying we're not going to do it, we're not going to do it, we're not going to do it. But the speed that the information is good, and the people in the media are making it a lot worse in spreading a lot of this fear. I've gotten calls from relatives. I've gotten hundreds of DMs, people saying, oh, is my money safe at Schwab? Is my money safe at FRC? FRC is one of the biggest custodians for hedge funds because they have relationships with all the prime brokers. So there are a lot of small hedge funds that bank with FRC, First Republic, and those guys can pull a ton of capital out given 68% of the deposits are uninsured. And everybody knows about this in the last 24 hours. It's not like 2008 where people were reading the newspaper or reading the Wall Street Journal. Information, like we have the spaces, there's a senator in the spaces. Mark Cuban was in the spaces. Everyone's sharing their info in real time, and that's making the impact in these moves a lot faster and a lot more severe.
It's your fault, Mario.
Yeah. If you see me in jail, you'll know why, guys, for market manipulation.
Well, it's Peter Thiel started it.
The point that Jay
If
touched
I
on.
could add, I want y'all's take on risk assets, given that all this kind of stuff is popping off. I feel like I just checked commodities; they're kind of flat, at least on the Dow. But I wanted y'all's take on smarter people than I have suggested that risk-on assets are going to start melting faces today. and I just got here, so I'd like y'all's input on that.
Is stock talk?
Sorry, I didn't understand the question. And I think Stock Talk, you were saying something.
Risk on assets are going to sell off today. I think that's going to be, if that happens, just general market related. I don't think that this is specifically relevant. It's more so relevant to small cap growth and technology companies that require credit facilities to operate. But we've already talked about that in detail. But to the point that Jay was making earlier about it happening so fast, like that was the broader takeaway that I had from this entire thing, which is that like today with modern technology, with a mobile banking app on everyone's phone, with every single major bank on earth having some kind of digital presence, what's different now than it was even just in 2008 is the second largest bank run in modern history, and this is maybe an exception to like the bank panics in like the early 1900s and like 1909 through 1914, but if you take those out, the second largest bank run in modern history was on Washington Mutual in 2008, and that was a $16.5 billion bank run over a 10-day period. And I talked about this last night, but that was enough to be the trigger that ended up leading to all the cascading events in Washington Mutual after that. But that's 16.5 billion in 10 banking sessions. That's a week and a half, right?
IndyMac was the same thing. It was it was literally 10 days. It
Yeah,
didn't
so
happen overnight.
this was 42 billion overnight. I mean, in one session, in one banking session from open to close. So, that's 3 times as large in one banking session. And the difficulty here is that any bank in the world is susceptible to this. Like, were there issues with the long duration treasuries that SIVB were holding, and are there similar issues at banks like Charles Schwab? Yes, there are. But on the whole, if you look at banks' exposure to long-term in general, and you look at the ability for these runs to happen, that's the scariest part of this. That's the biggest takeaway. Like conceptually, if you take all the nuance out of it, the scariest part of this is the fact that a bank run can happen within 24 hours if enough news spreads quickly enough on social media, and it doesn't take people lining up anymore. Like it's kind of odd that people were posting like screenshots of people like waiting in lines at banks. I understand the sentiment there, and I'm not discounting the panic of those people, but executing
It's
a
all
bank
happening
run is
digitally, right? Most
yeah,
of the
exactly.
outflows are
Executing
happening
a bank
over the
run
phone.
doesn't require people banging on. Like, there's a Simpsons skit about this. There's like Simpsons skit from like 6 years ago about this, where it's like Springfield Bank, and Bart walks in, and a bunch of people are waiting in line at Springfield Bank, and Bart starts
It's Silicon
whispering.
Valley Bank. It's
Yeah,
Silicon Valley
exactly.
Bank. It's on my Twitter. I posted on the weekend. It's
Oh,
actually
is it?
not even Springfield Bank. It's actually Silicon Valley Bank.
Oh, so it's one of those Simpsons predictors things again.
Dude, it happens so often.
But anyways, the
Yeah,
point
it
is
was.
like
It's
Bart's
exactly.
whispering to people like, "Hey, get your money out. The bank's insolvent," and then everyone goes and bangs on the glass. But the
One
funny thing
thing
is
to point out, that video is edited, so that's not real.
okay, whatever. Even if it's not
Okay,
edited,
yeah.
it doesn't change the point I'm making. The point I'm making is that that's not how it happens anymore, right? It's not. People don't need to line up at tellers and bang on the glass and ask for bundles of cash. They need to get on their computer, click 10 buttons, and now you have a withdrawal request in place. And if enough people do that, and it's so easy to do that, then you have a bank run. And that's all it takes now. And that's the scariest part of this. So I think if there's reform, immediate reform that's necessary, it's there to try to put measures in place to prevent that. I don't even know how you would do that. I don't even have an answer to that question. But it's terrifying that the digitization of the economy, this is one risk that has gone completely overlooked by banks. Like if you sit
Well,
down
in
with a
other
bank,
countries, the way they address it, I'm not saying they should do it, is in other countries they actually put limits on withdrawals. Actually, in 2008, I don't know if you guys remember, you had $200 ATM withdrawals for a decent amount of time in 2008. I'm not saying that's what should
How
happen because it
long?
might cause
How
more
long was it
panic.
for, Jay? How long did they give
It
that
was
limit
for
for?
several days. You had $200 limits for withdrawals from ATMs. I'm not saying you should do that because it might cause panic, but it might give the government some time to shore up some of the
but in today's
regionals.
climate, Jay, politically, where people are so distrustful of the government, that would backfire.
Well,
I
you don't have to do it on the biggest banks. You would do it on, you do it on the smaller names, but internationally, Eastern Europe, that happens all the time.
Yeah, I mean that's what they did in Greece. It's not a hard problem to solve technically. It's a very easy problem to solve. It's a perception panic problem, but technically you can just apply a lot easier.
I mean, right now, if you look at Nigeria, they have the same exact thing going on. It's $225 a week that you can take out of an ATM. India did the same thing in 2018 when they devalued 80% of the currency overnight.
I mean, these were the first two pumps of Bitcoin beyond the drug market, which was when you had the Cyprus bail-in and the Greek crisis, when they limited what you could withdraw, and then also the India monetization. Those were like the three early geopolitical spikes in Bitcoin when people realize they don't own their money, they can't spend their money, and inflation.
So guys, I have a quick question before going
If
to
I
Tom.
can just say something
Yeah, Wahid,
simple,
the question is for you, and then we go to Tom. But the narrative of the money flowing into those big banks, which led to a few of those stocks rising, I think it was on Friday. Is that still there? Do we have any concerns around the big guys, or is it purely the regional banks?
They're going to crush it. They're going to do so well. The money has to go somewhere. And it's not going into risk assets. It's not going into crypto. It's not going into it's going into US Treasuries. It's going into the bigger banks. And it's going into bonds. Investment grade. That's kind of how I think the market is going to perceive it, and it's going into precious metals, especially headed into this debt ceiling debacle. And crypto, obviously, crypto's up on the margin, but it's an $800 billion asset class versus, multi-trillion-dollar asset classes that are benefiting from this.
Okay, Wahid.
I mean, it's unfortunate that that this feels so pre-scripted, but the reality is we have to go through this. We have to go through a horrible crackdown and break in the system in order for central banks to capitulate. And unfortunately, I'm very cynical. I don't believe the world economy and world markets rely on anything else but liquidity and fund flow. And unfortunately, we need to see all this in order for them to just back off, capitulate, start a new cycle and a new bull market. It's artificial as hell. I hate it, but it is it's the way of life these days.
So what does
basically,
this
we just
mean
all need to
for
lend our money to the
rates?
US government. That's the solution, is lend
What's
more
that?
to the US government.
Simon, you know that I agree with you on all this, but I can't. My role is to just tell the folks on Twitter Spaces what I think is going to happen, not what I want to happen.
No, exactly.
Yeah, like
I mean,
in
we all
principle,
have to
some of the
lend
things you're
US
saying,
government.
Simon, make a lot of sense in principle, but I think when it comes to what is likely going to happen, it's hard. Those principles might be many years ahead.
Oh, they definitely are, yeah. But it's always going to be a trigger event like this that makes it happen, because it's not going to be done organically. It's just the tech isn't ready.
Tom, what do you think about the risk of a bank run? Is that something even worth? I'm talking about not a general bank run, not just regional banks.
Not really.
No,
It's a little bit of
we have 18 trillion
the
of
thing with the bank
deposits.
run, Fad. It's kind of it's good for the headlines and the clickbait. Obviously, I'm a content creator, so I understand that part of the business. The way it works basically is very simple. Look, it's a very unique scenario. It's probably not the last casualty, but I would say that the chances of super banks getting involved in this is pretty much the same chances of my grandpa dating a 19-year-old supermodel. Probably not going to happen, although possible. So it's
but
not that kind of contagion.
I think.
But can I ask
who
has more?
Table.
Sorry, who has more?
Hold on, Ryan.
sorry,
Sorry, just quickly, Ryan. What do you say, Ryan? Don't take the spot.
I'm saying the Fed took the possibility of a bank run off the table by saying that they're going to insure deposits. I mean, they're pretty much like they basically said, look, we're going to insure deposits. So equity holders of banks beware, because chances are your equity is going to be worth shit. That's why the banking sector is responding like it is in the market.
Do you think, Rand, that them saying, hey, we'll cover all deposits at these first two banks is completely dissolving of the possibility of a bank run? I don't think so.
They didn't say that. They said it basically at all the banks. The way that they worded it.
They did not say
all the banks.
No, that's not accurate.
That is not what
I haven't heard that. No.
That is not at all what they said.
Well, they've got the
Okay.
perfect backdrop for it, which is the run to
said
treasuries. It's just
what they said was we will make all depositors whole at Silicon Valley, and then they said the same about Signature Bank, which they took over the weekend. That's all they said. They did not say we will cover all deposits at all banks everywhere. That's not at all what they said.
This
But you guys
is
understand how
essentially
it
an
solves
exodus.
itself, though, right? I mean, the money is either going to go to the big banks or it's going to go into treasuries, right? People aren't going
I
to
think it's going to go to those two places only. Yeah, I think
it's not going to go into a swimming pool. So if
But
the
Jay,
money's,
there's the argument to be made there, though, then more regional banks and more hyper specialized lenders could fail in the next few weeks.
of course
Yeah,
they
this
could.
isn't.
I think that's the most reasonable take. I mean, that's been my take from the beginning. I think there is probably more contagion for some other regional banking or hyper specialized banking players. There is probably contagion for some small cap growth and biotechnology companies that were dependent on these credit facilities. And there is probably some benefit to the big four. That's, I think, the most reasonable,
if you were to construct the perfect pitch for how to secure a funding round for the US government, you've literally just created a scenario where everybody has to take their savings and lend it to the US government. That's what this does. And then those that are concerned about their creditworthy will just put it in commodities and in Bitcoin or gold. And that's the scenario you've created.
By the way, Mario, I just posted on Twitter a chart that pretty much shows you, even without the Fed stepping in, or so the government stepping in, that couldn't have been the case. There's a chart I posted on Twitter, not mine, I actually took it somewhere, but it shows you the framework of the percentage of loans plus securities as a percentage of deposits versus the retail deposits percentage. And you can see where JP Morgan is located with 50% deposits from retail and all, like 70% from loans. And SIVB, which is the Silicon Valley Bank, is at over 100% and sub 10% on the retail. So it's a very specialized kind of bad setup where the liquidity crisis was created. The deposits were actually, needed to support the clients, which were very specialized clients. But in all fairness, I should caveat what I said with one thing. I don't think there's any bank in the world that can technically withstand a 25% withdrawal in a single day from its deposits. Technically, I mean, that's not any bank can withstand that. But I think they have such sticky deposits, the big super banks, the Wells Fargo's, the JP Morgan, Bank of America. It's not gonna happen.
The only reason I asked this question is considering how fast information spreads, how easy it is to withdraw money, and how everyone's still a bit jittery after 2008. Just asking, like, what would it take for the discussion to change?
Mario, I think it's impossible to withdraw money. I know you can get like a certain amount in ACH, but the user experience of withdrawing money has never been more absurd in my life. I don't see money at a bank as my money. I've got to provide all sorts of documentation. I've got to provide, I've got to be treated as a criminal in every transaction above a certain amount. Like the user experience of sending money.
So could you explain that a little bit? Because I have over 20 bank accounts and I just give them my social security number and I can do well over $100,000 withdrawal or, with a lot of the banks in the US. So why is it so difficult?
Well, when you bank outside the US, you're treated by default as a criminal from FATF.
Yeah, absolutely.
So
I agree with
every single transaction I need to send invoices.
Where are you, Simon? Where in Europe are you?
I live in the Isle of Man, but I used to live in UK, then I moved to Hong Kong.
I have friends in the UK who tell me a very similar story. How like withdrawing cash in Europe in general is just like a wholly different experience in the United States.
Actually, every country except for the United States, because of United States regulations. That's what's the irony.
Yeah, if I want to spend more than 10K, then I'm preparing that's going to take 3 to 4 weeks and a whole bunch of work just to send it.
So if you're going to buy a house, so how do you buy assets?
He's right. So what happens is I live in South Africa and I bank with Swiss banks, I bank with Israeli banks, I bank with British banks, I bank with Hong Kong-based banks, and because of US regulation, and I did live in the US, I experienced both sides of the coin. When I lived in the US, I couldn't believe the freedom that you had in moving around your own money. You could do whatever the hell you wanted. If you live anywhere else in the world, you bank with like an Israeli bank, or you bank with a Swiss bank, or you bank with a British bank, the amount of questions that you get asked, even just to make a tax payment, like, show me the document, send me the assessment from the tax man. That's pretty much what you get. So in the US, you take it for granted that you can just do what you want with your money. But because of the US, because of all the regulations that the US has put on, you cannot move money around.
Yeah,
and the
for me,
banks
so
openly
you asked the
say,
question, how do I make investments? I basically spent a year explaining to my private bank, every single mining transaction I've ever done, all of the Bitcoin purchases I've ever done, all of the investments I've ever done. And I had to prove to them, which took about 9 months, how I generated my
Feels
wealth.
like you need a new bank.
No, I've been through a lot of every bank. Once you're connected to Bitcoin, they'll just, once you're, they're very scared of people that have any kind of net worth. They're okay when you're broke and paying a mortgage. But as long as you're paying, that's the business model that is right now. But the second I had to prove all of my wealth, and then once that was proven, I was able to go to a crypto-friendly bank that would allow me to OTC Bitcoin into another investment. And then they have to go through a whole rigmarole to get their compliance team to sign off on every transaction to gain access to the USD rails.
So I want to go to Tom again. Tom, what do you expect to see in the next few weeks?
Look, basically, sorry. So basically,
Ryan, your mic, Ryan. Just thanks, bro. All right, go ahead, Tom.
Well, look, they'll have to. First of all, I think what you said right now was the smartest thing I think I've heard in a while. Few weeks. That's the time frame. People, this is the digital age. We expect solutions within 24 hours on the weekend. So this thing is going to take a while to unravel. The regulators will have to get some time to figure this out.
So can you elaborate? What do you mean this thing needs to unravel? What do you mean by unravel? What is it exactly that's going on?
Well, look, the Fed will have to get some cash to figure out which kind of deposits they're gonna backstop. They're gonna have to create that fund to basically going forward to cover the ass of beyond the 250K, so that hold never gets created again. They're gonna have to create that insurance payments for the banks, and they'll have to figure out what's going on with the interest payments. I mean, I've heard really good
Breaking,
arguments for both sides.
the U.S. 2-year Treasury just came in 50 basis points this morning. Insane.
Yeah, thanks, Jay. By the way, I'm speaking to Jay today at 5:30 on the live stream on my channel.
Holy shit, Jay! I didn't even look at this.
Dude, I've never seen that since 08. A 2-day move of 100 basis points like that. From last week to this week.
Special, pull up the German to USD. Do you see that what happened overnight?
Oh my god.
Similar.
So can you explain just for the audience not taking? Can you explain what that means, Jay, and Stock Talk?
It means that the market changed its expectations for rates on a 2-year forward basis by 100 basis points. So the market is expecting cuts over the next 2 years, additional 4 cuts. Now, a lot of this, is due to this banking crisis. And if there is a solution, who knows what the solution is, but if there is a solution that comes out soon, you could see it reverse. But I have not seen a move like this since the financial crisis.
Speaking of and just to give people an idea, so you but generally speaking, stocks have an inverse correlation to yields. So when when yields are coming down, stocks will generally go up. But Jay, don't you think it's concerning from a sentiment perspective to see SPY trading flat here with that move?
Oh, of course. This is just 100% risk off. So back in 2008, what ended up happening was you saw all assets fall, right? Outside of treasuries, all assets had a correlation of 1. And when you have true fear in the market, that's what happens. We're not, at a point where you're seeing everything just puke, but you could see this week, crypto, stocks, commodities, all go in one direction, and the treasuries just continue to get bid, and that's not a very comfortable place to be.
You
Well, Jay, wouldn't
especially
you say
look.
that that's the? Sorry, go ahead. Whoever that was,
Yeah, so
I'll wait.
look at the CME Group's Fed Fund futures. On Friday, we had a 40% chance of a 50 pip hike. Now, the market expects no rate hike. Look at the Goldman notes from last night. I think Special tweeted about that. You Special, can you pin that note for the people here?
Yeah.
Well, I actually was about to make this point, so you came on a timely basis here. I was saying, look, there's arguments to both directions of where the Fed can take this, right? So they, on the one hand, they kind of created a backstop, which is essentially like theoretically, academically would allow them a runway to continue. On the other hand, obviously, there's going to be like political pressure to go downwards. So I look, the question is like, how many other banks are in a similar kind of mousetrap, like penis in the mousetrap situation, right? When you have when you did the safe thing and put money in bonds, and you got caught with the rate spiking within a year. So obviously, not everybody, not that, it's like a fingerprint. Everybody has a different fingerprint. So not the same situation with SVB, but I mean, I'm sure there's a lot of smaller regional banks which are in the same boat. And if I mean, you don't want to be the one who signed
But
his name on collapsing a bunch of regional banks.
yeah, I think Tom, like conceptually, and for this might simplify it for people. If I am the bank of Stock Talk and you come and you give me $10 million, and I think about, okay, where am I going to put that $10 million? So I put it in long-term treasuries, and then you come back tomorrow and you say, give me my $10 million back. I'm fucked because I paired it with a long duration asset. And assuming the
And
huge
meanwhile, the
assumption.
value of that asset dropped by
Exactly,
a
right.
bunch.
The huge assumption in this is in that period of time when you came back and asked for your money that we had to move in rates like we did,
Yeah,
right?
exactly.
But that's just the simplification, a massive simplification of what happened here. And the issue is that most banks in America, by structure, like even JP Morgan, if everybody with an account at JP Morgan called them and asked for their money, even JP Morgan wouldn't have it, right? Despite the fact that they're not, quote unquote, mismanaging their treasury
I would
exposure
even say one
the
quarter
way
of
people
account
said they would.
holders. One quarter of
But
account holders
Jay, we
would
touched
do
on
that.
this, I think, a few spaces ago as well. But the narrative that they were completely unhedged on their treasuries is actually untrue, isn't it?
Are you talking about SIVB or are you talking
Yeah.
about another bank?
No,
SIVB
because
on the
they were
HTM
hedged, right?
portfolio,
It was
they're
just the loan to deposit ratio, right?
no, it wasn't just the loan to deposit ratio. They're
But I'm
really
saying that,
underhedged.
but hold on. But on the point of treasuries, the narrative that I've been seeing put out there is that they were completely unhedged, like
They
completely
were
unhedged.
mostly unhedged. If you pull up the
But there was
financials
a
and you
guy
look
that came
for
up to a
the guy
space,
was
his
wrong.
space
The
ago.
guy was
That
wrong.
you're saying
If
that
you
guy was wrong.
that guy was 100%
Okay,
wrong.
I was
Just
just
pull up
making
the
sure.
financials. Pull up the 10K, look for the footnote and look for fair value hedge and interest rate hedge, and they were definitely not hedged. Otherwise they wouldn't have gone down so fast. That $15 billion hole, which was probably now a $25 billion hole, was all due to the fact of this guy top ticking $91 billion of MBS and not properly hedging it. If you go to B of A, for example, they hedge their risk. If you go to PNC, they hedge their risk, and they clearly have their fair value hedges in the footnotes of the K and the Q.
Yeah, okay. So see, that's what I thought it was originally as well. But then that guy that came up yesterday, he was like, "Yeah,
I
I
have no
closed
idea.
10K."
That guy didn't read the financial statements. I don't know what he was talking about.
Yeah, I was confused. You were there too when he came up, right? You know who I'm talking about?
Yeah, I wasn't
Yeah,
speaking, but I was listening.
yeah. He was the one that confused me because I thought the narrative was that they were unhedged. But I mean, okay, despite that, and going back to the earlier point, which is the real point here, even if they were hedged, right, 42 billion in withdrawal requests in one day would have caved them either way, right?
Yeah, even if they were hedged, if they had $42 billion of withdrawals, it would cause a liquidity problem. But you would argue that if they were hedged, they wouldn't see $42 billion
Right,
of
right.
withdrawals.
It's
And
like a
Thiel
sort of
wouldn't have gone on
yeah.
national TV. His deputy wouldn't have gone there and said, pull all your money out.
Right, yeah. The question is like, what's the catalyst that induces someone to spur a bank run, right? And in this case, it was that exposure. But you could make the argument that most people, in this case, maybe it was an exception because there were more industry people involved here, more VC people involved here, more people that knew, I guess, at least a little bit more than the general public about this stuff. It would be harder to have retail recognize something like that, right? Like I think the broader point I'm trying to make is that there are some
No,
people that are
retail's just running away. They don't know what the hell's going on. They're just pulling their money
exactly.
out.
I agree with that, and that's my point. Is that I think that there's been at least some people that have been trying to spread the narrative recently that like, oh, people should know, like regular people should know better about like where they're putting their money, or regular people should be
No,
able to
if I was a
identify.
dentist, I wouldn't know what a friggin'
Exactly,
interest rate swaption was.
So, but that's what I'm saying, right? Like, should we expect the American public? Should we expect everyday people to have the ability to do the diligence to say, yeah, I'm putting my money at a bank that doesn't have, either a solvency issue or a treasury exposure issue? Like, I think that that's an absurd
So,
thing
I mean,
to suggest.
Yellen should do a teach-in and explain that the 620
Just do a
billion.
class on Zoom or what?
They should do a class on Zoom. I mean, this is the 21st century. They should do a class on Zoom and say, hey, this $620 billion of total losses split between AFS and HTM. Half of it is already embedded within the CET1 ratio, and the HTM losses, the other half of the 300 odd billion, is mostly at the big banks. The big banks are not going to go under, and this problem is not systemic. These are government securities that if these banks hold these munis, and if they hold these MBS and they hold these treasuries for a couple years, right, this is not going to be a major problem. But one, who's going to pay attention to that? Is it going to cause more fear? I think the best thing for the government to do is to do a teach-in, and honestly, maybe they limit withdrawals at some of these smaller banks. They limit withdrawals on uninsured deposits. I don't know.
Jay, help me work through some of the flows of who benefits here. So let's just assume the everyday person, they've got less than $250,000 as an individual in their bank account. If they're wealthier, then they shouldn't have more than $250,000. It should
Well,
be
it's
invested.
businesses, right? So it's like
Exactly.
it's 5% of individuals and businesses. So when you're looking
Okay.
at someone like First Republic, it's hedge funds, right? That have accounts with First Republic. It's high net worth individuals, and it's small businesses, and that's why the number is to over 2/3 uninsured deposits. SIVB, it was all businesses, which is why it was over 90% uninsured deposits. But your small savings and loans bank on the corner. Most banks, by the way, of the 4,900 odd banks, including savings and loans, most banks, their liabilities are funded 90% with deposits. 90%. And
Yes,
most of
you're a
those
business.
deposits are insured.
Okay, so you're a business. You need several million in your bank account to meet your next payroll if you're any kind of size. A mom and pop business probably can stay under the FDIC limit and have some 3-month treasuries or something like that. But so the impact of this is that every business that has more than $250,000 in a bank account needs to make a move potentially, and everyone else is just
We don't
kind
want to
of.
say that they need to make a move with 10,000 people in this space, but yeah, I would
Well, they
say
need to
that
make decisions. They
they
need to
need to make
understand the risk.
decisions, and I would assume, and this is how I'm thinking personally, it's not financial advice, but if you have money at the too big to fail banks like JP Morgan or Bank of America or Goldman Sachs or Morgan Stanley, um, you're probably in a much better spot. Um, you should do whatever is the best for you, but people are going to put their money somewhere, and I actually think that the biggest banks are going to see more inflows, so their capital ratios are going to look a lot better, and their liquidity is going to look a lot better.
Okay, so you then manage your risk and you say, right, I need any amount above that at a tier 1 bank. If I need demand deposits, but the alternative to that is I need to go to treasuries. And so essentially at the same, that's like an attack. That is an attack on banks, right? That's like the government saying, you lend us the money because you can't hold it at a bank because there's no trust. So it's almost like the same thing as just doing a higher FDIC limit guarantee, but without essentially the bank currently is earning the interest, and then we're saying the bank now needs to meet a demand deposit. So the bank no longer receives that interest. And then you go and buy treasuries in your business and you take the bank out of that relationship. So who benefits from that? Because that would all be done via a custodian, right?
Well, I mean, if you're talking about people taking their deposits and buying treasuries, I mean, the U.S. government benefits from that, and whatever
But who's holding?
broker,
Because
you
on the
can go to
bond,
Treasury Direct and just buy, just buy directly off the U.S. Treasury's website, or you can use a broker. With a broker, you have a $500,000 SPIC guarantee in the United States that's broken down into 250 cash, or if you have an account that's invested, it's 500 total. So, then by the way, their brokers, what people don't understand is that brokers buy insurance and from reinsurance companies. So for example, Schwab actually guarantees your money for over $1 million in certain cases. Interactive Brokers is a very conservatively capitalized, and they have a cash sweep at several banks. So you're actually getting much more than the 250 or the 500 that you would normally think. So you really have to look at it on a case by case basis, and it's very hard to kind of answer these questions because everyone has different circumstances, and people need cash to fund working capital, and they need cash, right, to operate their business on
yeah.
a
So
daily basis.
forget the financial planning, just risk alone. If you're risk managing right now, you're a business. You have to have several million. You're trying to manage how quickly you need access to that money. You got 250K with FDIC. You could then buy some treasuries with a broker, and then you've got another half a million of coverage. And then anything above that, you could buy treasuries direct, and then there's no counterparty risk other than the US government. Is that in simple form?
Yeah, I mean, and there are other options as well, but in simple form, I think that's one way to look at it. But I don't want to spend too much time on this topic because I don't want people to freak out. You move on to the next topic.
Sure.
By the way, I have a question.
Can I jump in real quick here? Just a
Can I
couple
just
things.
ask a quick question?
Yeah, go ahead, Tom.
Thanks, I appreciate it. Just a quick question, Jay. Do you have any criticism toward SVB as far as the
There's breaking
protocol?
news. SIVB has formed a committee to explore alternatives for units. I don't think they were able to find a buyer over the weekend. I think PNC said no, and several other banks said no. So SVB Financial has formed a committee to essentially just sell the bank piecemeal. We'll see what happens out of that.
Well, we said yesterday that's the most likely options. I mean, right? Nobody is big enough to swallow them all that wants them. But I have a question for you. Can you comment a little bit about the risk protocol of SVB as far as what happened?
They didn't have a risk protocol.
That's what I was saying. Like a bank of 200 million billion deposits, you don't have credit swaps, no risk management. How could it be?
Well, I think it was very surprising to me, given that Becker was on, the San Francisco Fed board, and for him to be in such a high level position, I think they just took for granted the fact that they were getting, I think they got arrogant and they were getting 40 to 50 billion dollars. You had a huge venture capital raises at the peak of the market in 2021, 2022. These guys were pulling in, 40, 50 billion dollars a year, and they thought, okay, well, let's invest this in more, interest rates are zero, so treasury yields, are zero at the short end. Let's buy these mortgage bonds at 1.5%, but they're buying bonds with 10-year duration. And I'm honestly very surprised that they didn't actually, hedge it in a way, because it was held to maturity. I think they just thought, all right, well, just hold it for 10 years, and our business is growing so quickly that, as long as venture capital raising continues, we're going to always have higher and higher deposits every year. And what ended up happening, which I think that they didn't understand, was that, SVB was a little bit of a Ponzi. And I don't mean to joke around with that word, but it really was, because when you're a venture-based lender and a deposit institution, most venture capital portfolio companies run out of cash, within 6 to 18 months, unless you do another round. So, and a lot of early stage venture capital firms fail. So if you assume that these guys have a burn rate, of 10 to 30% a month, then the only way you're going to grow your deposits is if these VC firms put more and more money at your firm, and they raise more and more capital for their portfolio companies. That's why all these VCs kept telling their portfolio companies to put all their money at SVB, at Comerica, at PacW, at only a handful of banks, because
So
these banks
special.
were the only banks that were lending to these companies on the other end, providing venture debt and revolving credit. Go ahead, Gabi.
So along with that, I did talk to a couple founders that had accounts at SVB. They said they were the only banks that gave them so many perks. Like they had the lowest mortgage rates for founders. The only caveat was they had to put all their funds in the bank. That's what the
That's the
bank did
thing.
them.
So that's why so with the VCs we're getting, benefits as well. And the VCs had their money there. They're forcing their portfolio companies to bank there. Their portfolio companies were getting benefits from it. And it became a situation where SIVB shot itself in the foot because the CEO actually said that they didn't want to bank anyone outside of tech. They did some private equity LBO lending, but outside of that, and outside of real estate that was in-house to their own customers, they made a big mistake in not diversifying their assets and their deposit base. And the bank would only grow as venture capital fundraising grew. So when venture capital fundraising peaked, they already had a problem. 2 quarters ago, they lost 20 billion. Last quarter, they lost like 12 to 15 billion. And then they had to sell their $21 billion AFS securities and take that $1.8 billion loss. And when the market saw that they needed to raise $1.8 billion for the AFS, they're like, holy shit, they had 28 billion of AFS that's now worth 22 billion, but now they had, almost 90 billion of MBS that's probably worth 60 to 70 billion. What's going to happen on that when, their tier 1 capital is less than 15? So it became a negative. The market then realized that if they were to mark to market the held to maturity securities, the bank would have negative equity. And then on Friday, when Thiel scared everyone and people pulled out 42 billion, the bank actually ended up with negative 985 million before the FDIC came in and shut it down.
Jump in.
Yeah, do you think if Thiel did not say that, they would have lasted a couple more months at least?
I think they would have lasted several weeks if Thiel hadn't said that, because they would have raised 2.3 billion, and they might have seen some outflows, but the market wouldn't have been that sharp. Like Peter Thiel yelling fire is like Warren Buffett telling you to sell a stock, right? Thiel is part of the PayPal mafia. He was there with Elon Musk, and every single Silicon Valley executive and founder is going to listen to what he has to say. That's the only reason why you could possibly see $42 billion of deposit withdrawals in one day. That call happened at 11:30 p.m. PST when Becker was talking to VCs, and it was Y Combinator, Tribal, Thiel, and a couple other big spokesmen. And it was Thiel's dude who went on national TV on Bloomberg and blasted it to everyone. And I think that's what freaked out the market.
If
Yeah,
you short,
Mario.
if you short SVB, it's
Uh,
gonna be fucking epic. I'm
Well,
kidding.
I mean, it's gonna be frozen for a while. I think all these stocks, I'm surprised they're not halted. I'm surprised First Republic isn't halted. But of course, yeah, if you're short SVB, you're gonna make a lot of money.
I
No,
think
I
the
mean
most
I meant
likely.
Peter Thiel. If Peter Thiel is short and he did that,
Oh yeah. I mean, we don't know. I mean, he has a liquid hedge fund. I think they didn't do a deal that he wanted, and he was pissed off at them. Who knows what the motivations were? But it was very, very sus. He knew exactly what he's doing. He's smarter than I am. He's one of the smartest people in the world. I know he knew what he was doing. He completely destroyed their business overnight.
Yeah, Thiel is a genius. Look at what he did with Gawker, bro. If anyone
He
knows
did
the
the same
story,
thing. He
yeah.
screwed over Gawker.
Matt, do
The
you agree that this could be intentional by Thiel? So that's the first question I have for you, Matt. And then the second question is, where do you see the markets? I know Biden is giving a speech later today. Where do you see the markets if the Fed doesn't budge and we don't start seeing rate cuts?
First off, I think, well, good morning, everybody. I think special situations analysis is like spot on about the dynamic of Silicon Valley Bank and venture, like that entire cycle. The last part I would say, so it's hard to say they don't kind of mirror the excesses of the tech sector, right? Insofar as they were chasing growth at all costs. And a risk manager should have been able to foresee if I have 97% of my deposit holders are not insured, all it would take would be a few voices, like Peter Thiel, and not even many, to move that amount of capital out very quickly. Like that should have been on the risk matrix high up, but they chose growth, obviously. And once that starts, very hard to change that concentration of assets. So anyway, agree with you entirely on your take on it. And in terms of the market, I think there's one difference between where we were with regional banks, on Friday versus where we are on Monday, right? So the same thing that becomes a negative with Silicon Valley Bank, that there's this tremendous concentration of deposit holders who are very sophisticated, who can then catalyze the market to move those deposits out, can now on a Monday become somewhat of a benefit for those banks. And just to hear me out, there's a reason why you bank with these banks instead of JP Morgan or the bigger banks, is because banks are not commoditized. They have the ability to do lots of different things, extend terms quickly, favorable terms, mortgages, lines of credit, just the same way SVP was doing for this, for venture firms. All these other banks are doing in different sectors. So that means, it's kind of a degree of hand-to-hand combat. And now you have talking points on Monday that you didn't have on Friday. Talking points being $25 billion, the ability, that the Fed's not going to let us go under, et cetera. So I imagine that there's a kind of a ground war happening out there in the world between these different banks talking to their major deposit holders saying, trying to minimize the downside because of the moves the Fed made. The fact that the President of the United States is speaking right now should tell you all you need to know about their commitment to ensuring that banks survive. And by the way, we've had a relationship for 10 years. And remember the line of credit that I gave you. So, I mean, I think, not to start calling out some of the banks may be down just because of the prediction of, EPS with losing all that, outflow. But I just think today is a very different scenario for the banks. And it's, it's 8:30 in the morning, right? So that's just begun. In terms of the broader market, I mean, Goldman coming out saying now there's going to be no rate cut, which I think is actually no rate hike, rather, I think is actually very bad for the economy, because now we're kicking the can down the road. So I don't know why the market is reacting. I know why I'm reacting. I'm reacting saying, I hope the Fed goes through with that rate hike. I mean, if now we're in complete panic mode before we've even gotten around to taking our medicine, I think that's a disaster for the country.
Okay, you're one of the few that says
Yeah,
that.
cutting rates would be very negative.
It would be negative.
When it comes to the inflation.
Oh, to the
Yeah,
inflation.
cutting rates.
Yeah, for inflation.
Yeah, it would be
But
negative.
I actually think pausing
would
rates
be.
is actually not the direction we need to go in. I mean, when are we ever going to take our medicine? But
I mean, pausing is probably the right thing to do, and we're going to cut rates at some point anyway. It would just send a bad it would send a bad signal. But the bond market is leading, and the bond market's kind of telling you that that's going to happen soon anyway.
True.
So it is what it is.
Yeah. Fair.
Yeah, Mario, so Biden has a speech about the banking crisis in half an hour. Do you plan to play that there?
Yeah, we'll probably stream it. It's in half an hour, is it?
Yeah, it starts at 9 a.m. EST, so 40 minutes.
Okay, we'll
And
probably
just
stream
one thing to think about, playing a contrarian to myself before I get into the car. I'm going to be listening, but after this, I won't be able to speak. Is that if they were to cut rates and look past inflation, it would solve the entire held to maturity problem, right? Because all those bonds would be worth a lot more, overnight.
yeah, so you'd solve a short-term problem, create a bigger problem. But yeah, that's true.
Kevin, do you still have that same pessimism you had yesterday? What would change your mind? Kim, you there?
I asked.
Yeah, I am.
Well, first of all, I want to be acknowledged for my wisdom in shorting bank stocks. Buddy.
It's early.
And special, if your clients need any help with, a proper investment manager, just send them my way, man. I can help you.
So your thoughts on what would change your mind, Kim? What would change your pessimism that you had yesterday?
It's not pessimism, it's realism, because I looked at all the numbers. I looked at the outlook for the next 6 months, and we're just at the very beginning of these events unfolding. There are more banks in trouble. There's quite a bit of debt. There's quite a bit of problems to navigate through. And for anyone who was in this room yesterday laughing at me when I said I'm shorting bank stocks because my intuition tells me this isn't the end of the road, Look at the situation now, and it's only going to get worse. Like, if anybody thinks this thing is over, and it doesn't matter what the president says at 9 a.m., he's not going to be able to turn this around. I think he's probably going to make it worse because he can't stitch any sentences together. So I'm looking forward at what he has to say. But to me, this is just the beginning of a bigger market crash.
All right. Well, Stock Talk, I'll give you the microphone.
Yeah, I mean, I'm not confident in Biden's ability to rhetorically.
But does it really make any?
Here.
But does it really make any difference?
I mean,
what
rhetoric. Look, rhetoric matters, and me saying that is not a political statement either. By the way, I just think rhetoric does matter. I mean, one of the reasons Powell is often perceived as a dove or painted as a dove is because rhetorically he's good at being dovish. He's good at being reassuring, and rhetoric does matter, especially in a situation like this. I don't think Yellen's rhetoric was particularly moving either. And markets speak through price action, especially in the short term, right? And people say this all the time. This famous quote: "Short term, markets are a voting machine, and the long term, they're a weighing machine." I generally agree with that as well. But you see how the markets are expressing fear in short term price action. Yeah, bank stocks are down big today. I'm Kim. I know we disagree on a lot of stuff, but I mean, I was with you on that one. I've been short on these regional bank names for several weeks now, but the point really here isn't about where there is to make money. That's a separate conversation. If people want to have the conversation about trades to be made off here, that's a separate conversation. But really the question is do you believe this is a contagion that can be limited to regional banks, that can be limited to hyper specialized banks, or do you believe that a silver bullet has been brought out of the bag, as we talked about before, with the speed and accelerant of the ability to withdraw, right? If you use that as a metric, the ability to withdraw funds, we're in a much different place today than we were in even 2008. So much has changed in 15 years from that perspective. So I think this is the time to talk about, the core issues that this is exposing in the financial system, as opposed to being like, hey, it's an exception to the rule, or it's a limited case. Yeah, there are a lot of things about Silicon Valley Bank that made it an exception. It was a hyper specialized bank. It was involved very, very particularly with the VC growth and tech industry. There were, as we've already discussed in detail, issues with not only their exposure to long-term treasuries, but their inability to hedge those long-term treasuries properly. There were other management errors as well. And so all of this does pile up, and you can say, look, in hindsight, it's really easy to say that. But the question becomes, does the American public, do regular people even have the analytical capability to foresee these things or know if their money is safe at banks? And so I think there's a deeper sentiment issue here, but I would love to hear the panel's thoughts on that as well, if Kim or Jay or Matt or anyone wants to chime in on that.
Yeah, let me just weigh in with a basic observation that I think anyone who is following the stock markets can agree with. The markets were on the heroin of quantitative easing for years, right? That heroin has been taken away, and now you have a very fragile environment. You have markets that are not stable at all. And one thing that is quite telling is how quickly the Treasury, the government, the Fed acted yesterday to try and prevent a major crash. And that is telling me, because that's usually not what dinosaurs do, that is telling me that the panic is at peak in the US government about not having any kind of shock event in the markets that they cannot any longer compensate for with printing new money or other tricks that they have used in the past. So, it's quite telling for an observer who's watching the situation unfold, how unstable the U.S. markets actually are and how critical this time is, because the next major drop will not be cured with a big injection of heroin, meaning quantitative easing. Everyone needs to keep in mind that times have changed. They do that now. Inflation is going to go through the roof, and that will be just as fatal as a major market crash right now, because there will be no way to correct this. So everyone needs to, look at the situation with a bit of realism and understand what has happened over the last 10 years with quantitative easing and markets being artificially pumped. That show is over. So anything that's happening in the market now, which has almost no retail investors anymore, the last few years was always just banks propping up, stocks with
Retail's
money.
35% of the market now, and we're still at
So without
3,800 in
getting
the
into
S&P.
this debate, because we do have the Biden speech in 30 minutes, and I'm going to play it live when we get that. But Jay, I have a question for you specifically about your opinion on the Credit Suisse tweet. Gavin posted this about an hour ago. Gerg, you can repin it if you
Yeah,
want.
so
But
the CDS is
about
definitely a
the
new all-time
default
high.
swaps hitting a new all-time high. Do you think that there's any special risk at Credit Suisse compared to other banks? And if there is, can you explain, I guess, for the audience, what exactly you think that particular risk is versus other banks?
Yeah, sure. So Credit Suisse CDS hit about 450. Just so you guys know, at the end of November, it was also at 450. It tightened all the way down to 275 in the beginning of January. Then we found out that the CEO was lying about AUM outflows from their crown jewel business, which is their asset management business. Credit Suisse has a pseudo guarantee from the government. So eventually, I think that, the equity could be a lot lower, but it will potentially get bailed out. The credit risk is spreading across the European banking system in sympathy with the U.S. system. If you guys remember Europe, you had $17 trillion of negative interest rate yielding debt, and the majority of that was in Japan and Europe. So a lot of these banks in Europe have similar issues where they had bought bonds, some of them at negative interest rates, right? And now, Lagarde is trying to raise rates another 50 basis points, and some of these bonds are now yielding 3%. Imagine, the held to maturity losses on European bank balance sheets. We haven't really done a deep dive there, but Credit Suisse, has lost full faith of the investing public. The CEO has lied multiple times to the public. Their asset management business is shrinking. Apollo and some other private equity firms have come in to buy their CDO business. They're spinning off their investment bank, in a management type buyout. So there's what is left at Credit Suisse? And, that's the question I have, compared to all the debt that is outstanding, what are the assets that are
Jay,
left?
didn't
And
they
I think that,
also delay their earnings or their annual report that was supposed to be published earlier this month?
yes, they
So SEC
delayed
reached
it.
out to them. Yeah.
Yeah, they did delay it. So to put in perspective, 450 basis points is not the end of the world. We were there at the end of November, but it does show that this global banking risk is spreading. In the end, I do think that CS could be bailed out.
So Stock Talk, if you look at the press release about the delay, it said that is to do with the last 2 years, not with 2022. So nothing will be changed for
But
that
there
year.
was there's a Financial Times article on the
Yeah,
delay.
so the SEC called up the night before they were supposed to release their annual report for 2022. SEC wanted them to change some stuff that they mentioned and the way they calculated that for 2021 and 2020. Nothing for 2022.
So it was more just like a basic regulatory inquiry. It wasn't about anything.
Basically, I think if it came a bit earlier from the SEC, they would have already released that.
Regardless, the timing
Yeah,
is suspect, though, right?
Someone
it is.
on here, just tell me what the tier one capital ratios are for European banks versus what they are for US banks. And then let's have another conversation about European banks tomorrow.
I'm not
And
sure, but I know all of them were Canada. BMO
Canada's
18.
good.
Canada is great. I mean, all four of the big banks have almost 20 billion plus each because they have
And
been
and they're
saving
pseudo
for
guaranteed.
mergers.
And they're pseudo
Yeah,
guaranteed by the government. In Europe, the tier one capital ratios are much, much lower than they are in the US. Regardless of what we're seeing with some of these smaller banks, the US banking system today outside of Canada is one of the strongest banking systems on the planet.
Jay,
You
we
can
were
just
talking. We were
measure
talking about.
the capital
Jay,
versus the assets.
we were touched earlier on, like, which I agree with you on. The notion that bank runs in themselves are sometimes self-fulfilling prophecies. With some of these regional names where the stocks are trading down, 60%, 40%, 50% each. Do you think, assuming the public has enough attentiveness to the stocks and the trading of the stocks, that itself could cause people with money at those banks to say, oh my God, the stock is down 60% today, I got to withdraw my money? I understand that it doesn't function that way
Yeah, of
purely.
course. But in the
Yeah. So,
end, it's going to
you know,
be a small percentage of the total banking assets outstanding.
hopefully, right?
Yeah, so talking about Canadian banks and US banks, has anyone looked at First Horizon? So exactly 1 year ago, TD
Yeah,
from
the
Canada,
arbitrage, I've
yeah,
spent a lot of time on that with TD. They essentially did a deal at 25. They have
it's
a
20
ticking
now.
fee,
Yeah.
so it's going to be 20.65. As of today's, it's about 25.16. The exit date was what, May 27th.
Yep. No. It was March, so it's already over.
So
They have to,
no,
yeah.
they extended it to May 27th, and then over the weekend they said they might breach that May 27th out date. So what that means is that what the deal was supposed to close in March, then it was supposed to close in May. Now it's not even going to close in May. But this stock is sold off from like 25 to 20. So there's potentially a 25% arbitrage opportunity if they're able to close the deal. But now, given all what's happened in the in the banking sector, who knows if TD even wants to close the deal. However, it's an all cash deal. So this is if they do close the deal, it's a pretty sweet arbitrage opportunity. You just need to get comfortable with FHN.
So TD Bank CEO Bharat Masurani, he wants to retire soon, and he said he wouldn't retire unless he closes the deal. So he wants to get this done before he leaves the bank. I was talking to some people that were working on this deal on last Sunday. They said it's almost done, and boom, we had Silvergate, Silicon Valley Bank, and two other banks going down. So, but even if the deal falls through, the bank doesn't seem that expensive, trading 10
I
times
think the
yesterday's
break
earnings.
price,
Yeah.
so they call it a break price when a merger fails. It could be like 16, $17. But I guess if you assume all banks are worth less, maybe you discount that a little bit. But you do your analysis, down 3 or 4, up 6, your expected value is positive. It's an interesting ARB setup.
Yep. On top of that, they have 3% yield. This looks very, very interesting to me. And TD has to pay, I think, 30 cents on an annualized basis as long as they deliver the deal.
Yeah, I
And if
think
I'm not wrong, yeah.
to a cap of 65 cents. They could eventually pay 25.65 for the deal if they keep delaying it.
So Jay, so we touched kind of on the basics, and I guess trying to touch on it in a way where the general audience will be able to better understand the conversation we're having. But Schwab has probably been the biggest target in terms of the bigger banks. Eighth biggest bank in the United States, down 20% or over 20% last week. At its peak, it was down 20% in pre-market today. Now it's only down about 10. But what do you see as the particular risk there, again, versus other banks? So we talked about
Guys,
Yeah,
breaking news.
Schwab's
Fed
not going
swaps now
away.
show no more rate hikes as the most likely scenario, guys.
And that's, well,
Yeah,
hold on,
Schwab's
that's
not
market,
going away.
yeah.
that's good news. Some would disagree. I think Matt was saying that's not something he'd like to see.
Is
Yeah.
Matt still here?
I'm here.
Yeah,
Apparently, I don't make the decisions, but yeah, I would agree.
Yeah, none of us make those decisions,
So
unfortunately.
Matt, so based on the current Fed futures and Fed swaps, there is almost 80% chance of no rate hike the following week.
Yeah, no, I've been seeing that.
How do you feel about that? Yeah.
Yeah, I mean, I think that's obviously where things are headed. I just feel like this momentary crisis is eclipsing the real crisis, and that is inflation. So, the more we kick the can down the road, but
Could it be?
again,
But could we like, the whole narrative for weeks has been, if something breaks, the for months, not break, we're just waiting for something to break, and now could we have maybe there's more things we don't know. Maybe there's more bits and
Well,
pieces outside of
with
rate.
inflation, it's not as easy as you're framing it, right? With inflation, if the system breaks, it'll be extremely deflationary. Inflation will go away overnight. Already, we have deflation when it comes to most goods, and real estate prices are falling in the majority of the United States. Rents will fall, but it will lag due to OER, 30% CPI, 16% PCE. So over time, because not everyone's lease goes up at the same time, you're going to see those rent declines flow through into CPI and to PCE. Powell's talked about this in the last 3 meetings. So the only thing that's left is, your sticky PCE, so your wages. And if you see more and more layoffs, you might see several 100,000 layoffs just due to this
Well, that
SIVB
to
debacle
jump in,
because of
and
labor
the
laws.
reason why what you just said is the point why I'm making my point, that we haven't seen the wage relief, right, which only happens when the inevitable layoffs happen. So if this ends up being the catalyst, which very well, that's different. I just don't know if that's necessarily the case.
Yeah, I mean, I think even outside of this being like a full-blown banking crisis, I think inflation's going to come down
I want to just
dramatically.
follow up with something
It's just a matter of time.
something that Kim said, which is so true. Having been in government, I've been in every kind of crisis, 9/11 and so forth. The behavior of the government over the last 72 hours is incredibly uncharacteristic. And if you look at it as a sign, government can only act this quickly when the crisis is so obvious that they need to stem the tide. So whatever happened behind the scenes, it might actually be a bad signal that the government's been so nimble, because it means that they respect the gravity. That would be different if we were right in the middle of an election cycle, because then pandering plays into it. But this was very preemptive action taken by the Biden administration, which signals probably.
Do you think they had a choice though?
Well, all of us in a call, never really, most of us at least, didn't think they did. But the government usually opts for a half measure that satisfies, so let's talk about the political dynamic. You had a significant amount of the country thinking, I don't want to bail out these fat cats, Silicon Valley, who got us into this mess in the first place. That was probably the dominant narrative. And yet the reality is that wasn't the constituent. The constituent is the average American who's afraid they have to pull their money out, and how that could collapse the banking system. Usually you would normally predict the government would take a half measure, right? Would have released those advanced dividends, 50% of them or something. So the fact that they got ahead with $25 billion fund, over the weekend, signals how seriously they took. So I agree they didn't have a choice, but when does government ever do the inevitable quickly?
I think they're just reacting to the speed of information. I mean, 10 years ago, we wouldn't have seen 42 billion of outflows from a $200 billion bank in one day.
Is that true though? I mean, let's talk about it. If it was all concentrated in the hands of a few that have the ability to communicate very quickly and very efficiently, that $42 billion
Well,
would.
I'm hearing tens of billions out of FRC. I mean, I would say that's a well-diversified franchise.
I mean,
and SBNY just closed. The CEO didn't even know the FDIC was going to close.
Yeah.
The CEO was like, I was caught off guard. You shut down my bank.
Yeah. Where the FRC,
the speed of information is definitely
well,
I
guess with the FRC outflows, though, let's call them the retail customers, or were they the more consolidated, 70%? I don't know.
It's mostly high net worth and businesses.
Right.
So
that doesn't really take speed of information. That's a pretty wired group, if they had the internet. But yeah.
Come on, man. IndyMac took 10 days to take out $1 billion. We had Stock Talk on here talking about WAMU, took 10 days to take out $16 billion. It is definitely a factor here.
Well, regardless, it looks like rates will pause. So markets, I presume short term, will take that as a positive.
Evan, what do you think? Can we give credit to the Fed? They controlled inflation. We always try to criticize them. They controlled inflation. Something broke. They're reversing course, and then the economy or assets would rip. Is that a fair simplification?
I think we'll see, but I think the really interesting part is we literally have CPI tomorrow, and none of this data that's happening today we're going to hear about. It will take a couple months. I think that kind of goes to the problem with the Fed, that they're kind of using lagging data, which makes it so hard. But if we get a hot CPI print, I feel like that inflation debate kind of maybe doesn't get as clear. Maybe that changes some stuff. So I just think it's so fascinating with everything happening here. We literally have CPI coming tomorrow. And it's also double fascinating.
So Evan, on Friday, Biden came out and said he is confident that CPI will be in good shape next week. Those were his exact words. I don't think he has ever came out a couple of days before the print and actually said how it's gonna be.
Yeah.
And
I feel like you
and
only say
always
that if you know it's
remember
going to be good. So maybe that does give you a little hint, but
exactly, yeah, a massive hint because the White House gets the report days ago. And usually the CPI comes out the second week. This is the third week, so the numbers are already there.
Yeah, I think Gavin's right here. I actually noticed this on Friday when Biden came out and basically told us that he's basically telling us that inflation is going to be lower than we expect. So I'm actually expecting 6% or under. We know this is the government's modus operandi. They warn us in advance if they think it's going to move the market, and that's exactly what it's going to do.
So even now, the ECB swaps are a 50% chance of a half point hike for this week.
can I ask? I would love to ask someone smarter than me here, maybe Jay, Stocktop, or Gavin, or anyone else. What does this type of event, the last couple of days, do to inflation? Well, like, what are kind of those expectations? Now, obviously, we'll actually see in about a month or 2 months when we get the data. But what would you expect out of it?
A bank blowing up is it's hard to argue that it's not deflationary. Jay, would you agree with that?
100% deflationary, 150% deflationary. In fact, outside of a nuclear bomb hitting a major city, bank failures are the most deflationary thing that can possibly happen in a fractional reserve system.
Yeah, I mean it's literally a bank, going belly up. I mean, yeah, it's hard to do the math any other way. So yeah, that would be my simple answer to that question.
Okay, very good. Okay, well, I have another question then. I'm a stock market guy, and I feel like when we talked a lot about this, you guys kind of talked about when the Fed kind of stops raising rates. What does the stock market do after that? I feel like a lot of people might come and think that, ooh, it's off to the moon, but I feel like we're
So,
talking about isn't
so I
necessarily
think
like that.
people expect a rally, but if you look at the history, how has the market reacted on the last few Fed pivots? The market actually sold off right after that. The data doesn't back the people.
Why would the market sell off, Gavin?
So I'm not saying the market will sell
Why
off, but if you look at the last,
yeah, so why
if
if you
you
look at the past ones, why did it sell off?
I don't have the answer to that. We have to see what the people
Well,
sell. But
Yeah, there has to be a perception here of like, a lot of people expected a massive bounce here in pre-market in these banking stocks, right? Because they felt that, look, the government was basically insuring the entire banking industry in its statement over the weekend. But that's really where the lack of the nuance in the analysis comes in, is because they didn't say that at all. They said for the people that lost money at Silicon Valley, depositors, by the way, not shareholders. They said there will be no bailout of the actual bank or of shareholders, but depositors who lost money will be made whole. They said the same thing about Signature Bank. Now, the dangerous assumption here that maybe some people made who thought that we would see a massive rally is that, does that apply perpetually to every other bank in line that this happens to? And I don't know the answer to that question. I don't know if the FDIC's policy will remain. If 7 more regional banks fail, I don't know if that policy will remain in place. I don't know.
and you guys know what sucks? The Fed is in the quiet period from Saturday. The Fed is having a big meeting today, but they can't really come out and give a speech.
Yeah, Evan had a hilarious tweet on this where he said the Fed loves to talk all day, every day, but not when they should be talking.
So Evan, I would assume they want to come out and talk, but they are in a quiet period. The quiet period usually starts on the Saturday, the week before the FOMC meeting.
Yeah, March 11th is when they enter.
If it was an
Yeah.
emergency, they would talk, but this is an issue for right now. The
This is
Treasury
the
can
emergency,
handle
the
it.
special.
You know what? I kind of count that release yesterday. It said the Fed on it. I kind of count that as a talk, but we don't have to count
I count the biggest bank run in U.S. history as an emergency.
Agreed.
This is an emergency. This is it.
But if this wasn't in a blackout period, I really feel like we'd have 75 Fed presidents speaking today.
Bro, Jerome Powell would be on Bloomberg Daily, bro.
And just for you guys to, we're phrasing it in this way. A bank, this type of bank run is more important to to Powell than than inflation, right? He already knows the direction that inflation is going. He's not going to care as much about inflation with the deflationary impact of what's happening right now, right? You have probably several tens of thousands, if not hundreds of thousands of people who may or may not lose their jobs as California boards, right? Given the liability that they have, are forced to lay off people when you don't have access to airlines. You're going to have, companies like Datadog, Twilio, Oracle, Microsoft see their sales decline from, their 2,500 VCs that bank with Silicon Valley. Let's say each VC had 5 to 10 portfolio companies, tens of thousands of companies that aren't buying goods from those businesses. And then you're going to see a negative, money multiplier effect. So this is super deflationary. And if you see more banks decline or see difficulties, you're going to see inflation go away in a very short period of time.
But does
So
the
how
Roger, does the Fed stepping in, does that change things? Does that stop the deflationary
well,
effect?
the Fed's not saving the banks. They're just giving money back to the depositors. So yeah, it is positive. Otherwise, it would be a lot worse. And I don't want to be political. I'm saying it's positive because I mean you're seeing what the market is doing. After the Fed announced that. Imagine if the Fed had announced nothing. But I do expect that even with the Fed stepping in, unless they say they're actually going to bail out the banks, which people don't want to happen, right? The majority, it seems like the consensus U.S. average citizen doesn't want, like 2008 for the government to bail out the banks, even though the government made a lot of money off of TARP. But regardless, if they don't want that to happen, this is going to be deflationary no matter what.
Jay, let's play that out just a little bit for the audience because I know what you're saying because I'm close to the knock-on effects. But just to play it out, let's say that all the deposit holders can get their money back, the 160 billion, whatever was in the bank. So that means all those VC funds plus all those tech companies and startups getting their cash back. Etsy can do payroll. So let's continue to play it out while it's still so deflationary among that group and leads to layoffs and whatnot.
Well, there's $62.5 billion of lending off balance sheet and $45 billion of specific tech-focused lending at that bank. So you have over $100 billion of lending to those institutions. And these are companies that burn all their money in 6 to 18 months. They actually rely on the venture debt and the AR financing to fund payroll. A lot of these companies don't have that much cash to begin with. And because the market was down, they weren't able to raise new venture rounds. So what's happening is you're just accelerating the demise of a lot of these tech companies.
This was the point I was making yesterday. So I was trying to say this, and then you quantified it by putting an actual number on, which I hadn't heard before. So that's very helpful. That is the big, not contagion. That's the knock-on effect that was inevitable anyway. Jay, I don't know if you feel that way, but they were, I think, handing out debt that other banks wouldn't have done anyway. But regardless, all these companies were also using that to extend their runway. There were covenants, so to some extent, those lines aren't always very helpful. But we basically just, shortened the runway dramatically for thousands of companies that have tens of thousands of jobs. That's I think the ultimate deflationary impact of SVB going under.
I think it's not just the jobs; it's the products.
You're right. It's the
important.
jobs, the
It's
products, the services. It's also, by the way, I said this yesterday. You have, all the funds that had money and the term sheets out. All that activity seizes up. That's just the nature of the beast, right? So there's going to be paralysis for a period of time on any new, to the extent to which any equity was getting done in this sector. That's going to totally pause.
And Simon, since you jumped in, what do we expect to see for crypto? We've kind of moved away a bit from crypto with all this playing out.
Well, Bitcoin has always had a lag between how people perceive it in the short term and the problem that it solves. So I've always said that Bitcoin gets adoption when people realize they don't own their money, can't spend their money, or there's inflation. But it always acts as a risk-off asset. A risk-on asset in the short term, and we expected it at some stage to decouple from the stock market, but
you dropped out, Simon. Oh, you're back. All good.
Yeah, we expected it to, long term fundamentally, it's been in Bitcoin's been in a 14-year bull market, and the top 10 or top 20 cryptos change every year. So crypto is just a trading speculative game, and Bitcoin is always been in a 14-year bull market with massive corrections in between. And so, you know, all of the trends that Bitcoin solves, ownership of money, the ability to spend peer-to-peer, and to combat an increasing money supply are the same. But short term, you just get these pump and dump cycles every 4 years. You get a halving cycle, you get, and then you get, you know, we're moving towards a world where Bitcoin is a commodity. Ethereum is questionable about whether it will be a back layer for many securities, and everything else will likely become a security, and then there'll be international competition. So it's interesting that this is, I don't, you know, you can't read much into a 1 day, 2 day, 1 week thing in terms of long trends. But it's interesting that Bitcoin's gone the opposite way of the market. That's a very interesting signal to me.
Cool. We're going to be streaming the Biden
I
speech.
totally agree with you, Simon. I think that's a very interesting development, and it may be the time where you know, the crypto scene finally realizes we don't need to rely on, you know, U.S. markets or whatever. Like, we can do our own thing, and if that's happening, then that would be a very good development and a positive outlook for crypto.
Yeah, I think what's important is as a Bitcoin business, you know, nothing has stopped for us. We can meet payroll, we can transact. The whole treasury management. Now, I know we're a bit of a niche business and it's pretty complex, and we know the intricate details. But the important part is that everything still works for us, and we don't, you know, the banking exposure is a slight issue, but we can still pay all of our staff in a stable coin. We can still pay all of our team in Bitcoin. And we've got a culture that would prefer Bitcoin to meet their payroll then, and I know that that's not, you know, that's not normal, but we were completely protected for this.
Yeah, Simon, that's what I was going to add. That short term, there is some trouble with Silvergate and Signature going down. There's definitely some havoc in the mostly in the crypto space, but in the Bitcoin space as well, with their on ramps and off ramps to the traditional banking system. But all it will do in the long run is speed up non-reliance on the traditional financial system. So everything that was going to happen, let's say 3 to 4 years from now, will probably start happening over the next year, where there is going to be more of a circular economy within Bitcoin. Short term, you know, people may not be able to buy as much as they like from like Coinbase or some of their resources, but within the Bitcoin ecosystem, more people will now be forced to convince their suppliers and just to create a circular economy within Bitcoin, kind of like the way Russia and China and India are now speeding up, you know, having their own system because Russia got kicked off of SWIFT. It's kind of similar in a way with Bitcoin. And Kim, I agree with you in that debate you had yesterday. China and international big countries not buying U.S. debt and selling U.S. debt is a big deal. Even though Western buyers stepped up, this is a big deal.
Yeah, and I was scolded at yesterday for pointing that out, but it is a very big deal. And what people need to understand is what that means is the US government has great difficulty now raising more debt. And the only tool available to them is money printing, which is going to have a direct effect on inflation and long-term, potentially hyperinflation.
It's a short-term effect. If I told you that bond prices were going down, the most logical decision, being a smart central banker, would be to wait for rates to peak. And I said this several times. If you read any financial documents from a big Japanese bank, they're all saying that due to FX related issues and waiting for the Fed to see peak rates, right? That's why they're not buying the debt. They're not buying the debt because, oh, the US is a terrible place to put their money. Where else are you going to put your money in the world? You know, these are all kind of false narratives. And I'd
Well,
like
you
to
can
ask
put it
how
in
many
gold,
people in this audience are using
silver,
Bitcoin to buy anything,
resources.
anything useful?
Yeah, well, that's
Mario,
the point.
4 minutes to go for Biden.
Okay, perfect. Cool, thanks, man. Who'll be just
It's
before
a good point.
hold on, guys, hold on.
Simon, hold on.
Just want to confirm, who'll be streaming the Biden speech, stock
I
talk?
can play it. I have it pulled
Stock
up.
talk, you have it?
Ah,
Yeah, I have
perfect.
it pulled up, so I'll play it right when
Perfect.
it
Cool.
goes live.
All right, so go ahead.
Can I respond to that?
Go ahead, guys.
That's the whole point. Bitcoin is a two-tiered economy because fiat currency makes you spend your money and it's incentivized for you to spend. So obviously that's good for central planners that believe in Keynesian economics. But Bitcoin is a side-by-side experiment in Austrian economics where you don't want to spend your money. So most people in Bitcoin are really thinking about saving and a wealth effect. And they do everything they can not to spend their money because they believe that it will be worth more in the future. And once they hit a certain net worth, they tend to try and borrow fiat against it and try and build their wealth intergenerational and long term.
It still doesn't work without fiat.
Absolutely. It's a two-tiered economy, which is why you have CBDCs and Bitcoin in the end.
Simon, but also it's a bit of a tricky question at the moment because Bitcoin has been down 60 to 70%. So when you ask the question today, yeah, not a lot of people want to spend it. But if Bitcoin was sitting at an all-time high right now, yeah, there'd be a lot of people spending it. The Bitcoin spending goes way up at the end of bull markets than at the bottom of bear
how are you
market.
going to buy your pizza at Domino's with Bitcoin? How are you going to buy your
Bitcoin
clothing
debit
at
cards,
Target
you
with
borrow
Bitcoin?
against your
How are you
Bitcoin.
going to buy your automobile?
You convert
you buy all of that.
Very simple.
You
guys.
can't. Not where I live.
Hold on. There are things I do with Bitcoin right now. My barber accepts Bitcoin. There are certain people that I shop at, and there are certain services that I use specifically because they accept Bitcoin.
No, but you use your Bitcoin
that lowers your economic utility. If you're going to a barber just because he accepts Bitcoin, he might be a shitty barber. It just defeats the entire economic premise.
But he might not be, right? Like that's not a correlation,
guessing.
right?
He may not be, but if you're just going to say I'm going to go to a barber because he uses Bitcoin, he very well. It's more likely that he's a shitty barber than a good barber.
That is not true at all.
It's not the right argument.
You just demonstrate again how little you understand about crypto. Thousands of vendors are being added every week to accept crypto. So, it's just a matter of time until even the best barber is accepting crypto. And by the way, if you ask how to buy your coffee, people who have Bitcoin can just convert some of their Bitcoin to their little brother Bitcoin Cash, and then you can pay for anything without any fee instantly.
No, but the point is
Bitcoin Cash.
It's not a Bitcoin versus fiat world. It's a Bitcoin and fiat world. It's like saying gold is useless because I can't go and use it as a barber.
Exactly. I view Bitcoin as a commodity. It's like, all right, am I going to have all my net worth in gold? Absolutely not.
But the difference is that you can program financial products on top of it to pull out fiat as collateral on your Bitcoin. You can connect it to a Bitcoin debit card.
So guys, we've got
exactly.
Before you respond, Simon, we've got the speech will be streamed in a minute or two. So I just wanted to let everyone know. Also,
I'm assuming, just full disclosure, I'm assuming Biden will be a few minutes late.
He's always late, so you need to be used to
that. Can I say something else on rates real quick? Someone said that Powell fought inflation with rates. I don't agree with that. I don't think raising rates actually fights inflation. The inflation was always a fiscal problem. It was the shutdown of the economy, was the way the economy was run. And the Fed is always lagging. The Fed just does what the free market forces it to do with the interest rate. Now that the free market has forced the 2-year interest rate down and even the 5-year interest rate down, the Fed's going to slow down. The Fed's always been a follower, and also there's nothing stopping the stock market from rising with the interest rate going up. It usually does. It means the economy is strengthening. Basically a little bit that allows the Fed to raise rates. So I think that correlation is like the way people think about it is incorrect.
I think that's incorrect. You think real estate prices are falling because the Fed is cutting rates or because it's raising rates? The biggest asset class in the world.
Real estate prices are falling a little bit. They're not falling all that much. I just sold my condo.
Jesus Christ, you keep talking about your barber in your condo. Look at prices
I just sold my condo a month ago, and I got a bigger price for it.
Look at prices in San Francisco.
Okay, hold on. Wait, hold on. I was in
Hey,
contract to sell my
Grandpa's
condo
here.
a year and a half ago, and I
Hello,
sold it last
breaking,
month for a
breaking.
higher price.